right. Good morning. Good morning. Today in our People Matter show, we have a special guest, Jack Miller. He is the president for Gelt Financial. Also, he founded residential and commercial property management firms. He started multiple financial firms and companies as well. And he has a vast experience in commercial real estate and lending. So welcome, Jack.
Pleased to be on your show and be with your audience, and I'm excited for the next half hour or so. I'm looking forward to talking to you and exchanging ideas and thoughts and learning from you. And I apologize, my phone went off, so I apologize, but looking forward to it.
So, Jack, let's start with a little bit about, obviously, your experience is something that we're going to try to leverage today. And 30 years in the lending business, residential and commercial. You are in Florida. Why don't we start a little bit with your background? Obviously, we know commercial risk, residential. Tell us a little bit about Gelt Financial, a little bit about what you guys doing right now and something new that or exciting that you guys are doing right now.
Sure, I'd love to. I started the company February 1st, 1989, so we're a couple days older than 36 years. We started out doing residential mortgages. We're private lenders, and then we started to do commercial loans in 1998, August of 98. So our business model is we're private direct lenders. We do commercial and residential non-owner occupied or business purpose loans. So we don't do, if you're going to live in the property, we don't do that. It's investment properties. We, at this point, have a national platform. We operate in, I think the number's 37 or 39 states throughout the country, most major MSAs, and we portfolio our loans. Borrowers are coming to us for one of two reasons. One, speed. They need to close very quick. They're perfectly good credit, can go to a bank, but they just need quick execution, and we deliver that. Or the other is they can't go to a bank or don't want to go to a bank for all kinds of reasons. And we work with real estate investors, owners of small businesses all over the country. Every day is exciting. We get to help people, and we're so lucky our borrowers are really grateful to us. It's a pleasure, a really pleasure to deal with our borrowers. And I'm constantly learning from them because we deal with extremely bright and creative, hardworking people. I love people, risk takers that are hardworking and they're just creative. So we love what we do here.
Awesome. Tell us about your team. How big is your business, your company?
We're not terribly big. We have 13 people in the office in South Florida, and we have a few outsourced people who work remotely. So, and we're very lucky. We have had the same team for many years. They're very experienced, and really the truth is they get all the credit. I don't do much. They get the credit. So we have a great team.
All right. I have a lot of questions for you. I think this is a very interesting topic when we talk about private lending, commercial, residential. There's a lot of people out there that they don't qualify for conforming loans, for, your Fannie, your Freddies, your FHAs. They don't qualify for those. So tell us in a nutshell, if someone wants to buy a house, now you said at the beginning that you typically don't lend for people that are trying to buy, to own, to live in the property. But do you have an option for those people that don't qualify conforming, don't qualify on the typical conventional loans? Do you have options for them to be able to buy a home to live in?
Yeah, no, we're not a residential lender. We don't do that. That's not our thing. We're focusing on real estate investors and commercial property owners, business owners. So our typical client will buy a property and they'll either fix it up and sell it or fix it up and rent it out or whatever it may be. But it has to be business purpose loans.
Okay. So now business purpose, can it be also a property that is, you said, for example, if I want to invest and renovate a property and sell it, but it's a residential property?
Absolutely.
Okay.
Absolutely. As long as you're not living in it, we can take a look at it.
All right. So let's talk about that. So there's a lot of people out there that are into the renovation business. What is typically, for example, there is a property right here close to in New Jersey that needs a lot of renovation. What is the typical LTV, loan to value, that I need to be able to participate? And what's the typical credit score that you look for to participate on a lending program with you?
So we're not credit score driven, we're property driven. So we're putting 95% of the emphasis on the real estate and the collateral, not necessarily the individual. We look at the credit, but we're not basing decisions on that. But to answer that question, we'll go very low on the credit scores. We do a lot of foreclosure bailouts, bankruptcy, Chapter 11, DIP financing, and exit financing. So we're not really focused on the credit score. In terms of leverage, we like to be, it all depends on the area, the city, the state, but generally 65% leverage, which is different than loan to value. And I'll explain that in a minute. That number can go higher depending on the product and the location. So if you're in a high growth southern state, we may go up to 70 or 75%. But leverage is a little different than loan to value. So just to use a $100,000 number of value, we want to lend about $65,000. Now, if you're buying a property for, let's say, $90,000, but it's really worth $100,000, then we'll go $65,000 on the $100,000. So we'll still be at that. But again, it's real value, not made up value. To be candid with you, we get calls all the time. Oh, I'm buying a property for 100, but it's worth 200. Well, why is it worth that? Because, but there's no real reason. So we're basing our number on the real value, not necessarily. And another thing, a lot of our deals are blanket loans. So give you a real life story. A guy calls up, I'm going to say 6 months ago, he had one property he bought for 450 grand. He owned another property for like 400,000, no mortgage. We lent him 450. Actually, we lent him a little more because his closing cost, I think it was 480. And we took a blanket on both. He viewed it as, oh, Gelt gave me 100% financing. We did. We looked at it at like a 50% leverage because we had both properties as collateral. So there's a little bit of a difference between leverage and loan to value, and we use leverage, not loan to value.
Okay, very good. What is the average interest rate in today's market on those loans?
We're more expensive than a bank. Right today we're 11, 12%, something like that, depending on the product. If it's a small loan and it's a foreclosure bailout, it's going to be more, but around those numbers. We're generally going to be 400, 500 basis points more than a bank.
Very good. Fair enough. I mean, you're very lenient and you're very willing to lend when others they say no. You're taking more risk as well. Now, is it normally this type of loans? Is it a fixed loan, a short term, 5-year, 10-year? What are we talking about? What type of terms are we talking?
So we're generally under 3 years, under 5 years. Most of the time, the borrowers want shorter terms. We'll go out longer. So even though I'm telling you we're under 3 or 5 years, I think the number is we have 40-something loans on the books more than 15 years. So we're fine with doing longer, but most of the time the borrowers want options. Borrowers are coming to us to either make money with our capital, they're using us as a tool. And they're not looking and say, oh, what's the cost? What's the cost? They're looking and say, what can I make? Because without our capital, they're not doing the deal. We tell borrowers, if you can go to a bank, if you have the credit, the income documents, and you have the time, go to a bank. Why pay more if you can get it cheaper? Go to a bank. But if you can't go to a bank and you need to do a deal, we're an option for them. So they're looking at it. Most of our borrowers are looking at it and saying, we're a partner with them in the deal. We're providing the capital and going to help them make money on the deal. Or they need to solve a problem, maybe get their credit in order, maybe need to sell a property, different things, get through a divorce or a bankruptcy. So most of our borrowers are using us for a short term, but there are some who like to use us for a long term, and we'll keep extending it. Even if we have a 2-year deal, we'll extend it for another year, another 2 years, or another 3 years, or whatever they want.
So blanket loans, you just mentioned it, and I think it's important for the audience. Explain briefly for the audience, what is a blanket loan?
It's securing more than one piece of collateral. Sometimes a borrower will have a portfolio of real estate. The example I gave, which was a real life example, it happens all the time. Borrowers are maybe buying a property, but they own another property, and we'll blanket both properties, or sometimes it's 3 properties or more, as collateral. So you're taking 1 or 2 properties and blanketing the value and the leverage on.
So, for example, and let's just put it in terms of a scenario here. Joe is trying to buy a property, doesn't have the cash, has a property that he's living in, and that property has a lot of equity, and he can use that property as a blanket
Well,
loan.
remember, we don't do owner occupancy.
Okay.
If he's living in it, we won't do it. But if it's an investment property, we'll do it.
All right, got it. So it has to be an investment property to use as a collateral.
Yes. Now, if he's living in it, he may want to go to home equity loan at a bank or something like that and use the money. But if it's an investment property or commercial property, absolutely.
Is there a minimum that he has to come out of pocket?
Absolutely not.
Okay, good. Good info. Let's move on into commercial business. You know, you mentioned that you also provide loans to businesses as well. What is typically, if I'm interested in buying a business, and it could be any business, it could be a laundromat or whatever business. Tell the audience what typically you look at when you're looking at to lend for a business. And let's assume that for this scenario, the business is $1 million. And what is typically the what you look to be able to qualify for a business if you want to buy a business?
So we're real estate lenders. So the loans we're doing are the loans that the business, the real estate's in.
Okay.
So a perfect example, we just closed on a loan, a suburb of Atlanta, Georgia. A lady had, I think, 4 or 5 daycare centers, and she was buying another daycare center. So we lent her the money on the real estate that the daycare center was in. So we're looking at the value, we're looking at the income, we're looking if something happened, can it be leased out and how much it can be leased out for. In this particular case, she was a wonderful person. She is a wonderful person, but she didn't verify her income. You know, she doesn't have the best bookkeeping and accounting, so she couldn't go to a bank. So her documentation wasn't in order. She came to us. We liked her business, we liked the real estate and the collateral, and we provided the financing for her and closed the deal.
That makes sense. Now, this show, I mean, normally we're trying to educate the people out there, either at a professional level or as a consumer. And this question is mainly for our audience that is trying to learn, and they're trying to basically prevent to be in the middle of a difficult situation or a scam. So what would you recommend for people that are trying to buy a property? It's very common, and I see it all the time. They're trying to invest in a property that is destroyed, that is trying to flip it, and they're trying to make money. What have you seen the most common scam is out there when people are trying to invest in a property and flip it, and that way they can make some money?
You know,
have you seen some scams? What is typically those type of scams that you have to be aware of?
So look, scams or mistakes, they're two different things. You know, what we see is borrowers make mistakes, not necessarily are scammed. They have to be sure they know the real value of the property and not buy into some pie-in-the-sky number. We've made so many YouTubes and so many videos on this because we see this all the time. So they need to have a really good understanding of what the real value is and not use a crazy, oh, it's sold for this today, in 6 months it'll be worth 20% more. They have to be realistic. They also have to be very realistic about the cost to do the repairs. You know, oftentimes a contractor's lowball bid. So they'll say, oh, it's going to cost 20 grand and it costs 60 grand. So we see in probably about 80% of the loans we do, the costs are always cost overruns, always major cost overruns. So be very aware of what the real cost is and keeping in mind inflation. And there's always things you're going to miss. Don't go through it and say, oh, it's going to cost 10 grand and it's easy. And we also see borrowers also make mistake in the length of time to do the work. You know, they think it's going to be 30 days and it takes, 90 days or 6 months. So be very cognizant of the fact that it's going to take longer. Also be cognizant of the fact that some areas you may need permits or may need to get the city involved. So be aware of these things. And the other thing we see is borrowers are always too optimistic in terms of what they're going to sell it for. They always think they're going to sell it for top of the market. And they underestimate that there's closing costs going in, there's carrying costs. which are expensive, and there's closing costs when you sell it. So to be very blunt, borrowers are sometimes over optimistic and they need to be overly cautious and they get themselves into trouble. If they do it right, they'll be fine, but oftentimes they don't do it right and they need to learn and learn from the right person. Don't learn from a real estate broker who's making money teaching you or someone who's charging you money to teach you. You got to learn from the right person and you could do well, but you can also get hurt if you make these mistakes.
That is a great advice. Thanks for that. Now, I know that you're doing business in 36 states. At a national level, which states would you recommend staying away from if you want to do flipping properties? And we're talking about flipping properties. And which states do you think are more attractive to invest in flipping properties?
You know, you have to take certain things into consideration. Certain states and certain cities are more difficult in terms of your permitting, in terms of if you have to evict a tenant or something like that. Even though you may not think you're going to get a tenant, but certain states are just more difficult. As well, certain states and certain locations are decreasing populations and certain states are increasing populations. So, you know, I would pick, but you also have to be aware where you live. So I always say, whatever it is, I would pick where you live is the best place because you're going to be able to learn the values. You're going to be able to drive by the property every day. So where you live is always going to be the best states. But, you know, there are some cold hard facts that certain cities and certain locations are increasing. Populations are growing. Values are growing. You know, so I would go with if you're not taking out where you're going to live, I would go with a growth state and see which MSAs are growing. And certain states are growing and certain states are reducing populations.
Well, we know that, for example, Texas, Florida are one of those states right now that property are decreasing, inventory is rising. We know that some other states like New Jersey, inventory is still very low. So I was just, I think that it's a very interesting business that I see a lot of people trying to jump in, the flipping. So in regards to the terms, going back a little bit on the loan side, does it have any type of penalty if I want to just use it for only a few months instead of a couple of years?
Look, if we know that up front, that's fine. That's built into the deal. If you're talking like a fix and flip and fix and hold, you go to the lender or you go to us and say, hey, I need the money. I may be out in 30 days or 60 days or whatever it is, and that's dealt with that.
Very well. So I see on your website, and you have also talked a lot about bridge loans. Can you explain to the audience, for those people that want to know more about bridge loans, do you offer them right now?
100%. We do a lot of bridge loans. So a bridge loan is basically a loan for a short time to bridge a situation, whether it be they're in trouble or they need to make money with our money. You know, they're using our money for opportunity costs. So it's generally a short-term loan. You know, it could be 6 months, it could be 3 months, it could be 3 years. It just all depends on the situation. But it's to help a borrower solve a short-term problem. You know, once they solve the problem, then they put permanent financing on.
Right. Now, can they, and this is it might be a dumb question, but, can you mix a blanket loan with a bridge loan?
Absolutely. Absolutely. A lot of them are. Absolutely.
All right. Good. Look, I'm learning here. And I mean, my experience is also on the lending side, but on the residential side. So this is very interesting as well. So you said that you mainly keep the loans. You service the loans. You have a mortgage servicing portfolio. What is typically in your industry? What is typically the amount of how many years typically a loan stays with you guys?
Yeah, so first, I'll answer that in a second. You know, you're dealing with residential, so you're effectively selling to Fannie, Freddie, or non-QM, or the agencies, the government, FHA or VA. So really, every lender has the same guidelines. It all comes from the government. With us, the difference with us is we don't have any guidelines. It's common sense. There's a price to pay for that. We're more expensive, but we have a lot more flexibility than the agencies, or if it's a government-based loan. We're generally, to answer your question now, I don't want to avoid it, we're generally a short-term lender. So most of our loans, they're on the books for about 2 years. I think 2 years and 2 months, but that's over hundreds and hundreds and hundreds and probably thousands of loans. So
Yeah.
some borrowers borrow the money for 30 days and some borrowers borrow it for 5 years. So it just all depends what's going on with the borrower. But generally, we're not, because they could borrow it cheaper somewhere else. So they're taking us for the first step of the transaction until they could stabilize it and then go somewhere else.
Awesome. Jack, I mean, you've been in this industry for many years, over 30 years plus, and you've seen everything. You've been in the in multiple crises that we've been through, and you've been in ups and downs. What is the number one mistake that a young professional entrepreneur, when it's about investing in real estate, what is the typical mistake that they do?
You know,
What have you seen is the typical mistake that a young entrepreneur does whenever they want to invest in properties?
leverage. They're using leverage wrong. They're borrowing too much. And the close second is more companies and people die from indigestion than starvation. In other words, they're doing too many deals. You know, you mentioned flip, fix, and flip before. You see a lot of guys doing it. I would say to you, find people who've done it for 10 or 15 years or more. You're not going to find too many. Because what happens is they make the same mistakes over and over. And we've done a lot on this. One of the mistakes is they'll do one, they'll do another, and they grow too fast and they can't handle it. And that's why I say more investors die from indigestion than starvation. So it's better to do it slow and steady than quick. Take your time because a lot can go wrong and a lot does go wrong.
Yeah, absolutely. If I'm looking for a company like yours, typically what should I expect should be the closing time from the day that you guys take the application to the closing time? What's typically the turn time?
It could be very fast. We just closed the loan yesterday. We're making this on a Thursday. Yesterday was Wednesday. We just got the loan in Friday. So really, in that case, it was 3-4 days. That was the exception, but it just happened. And that happens all the time. Usually a week, 10 days with us is the closing time.
You guys do an actual appraisal of the property?
No. With us, we don't do appraisals. We do what's called internal valuations, and that allows us to close quick.
Nice, very nice. So for those people that internal valuation, basically you have a system that does comparables in the area, I would assume, and based on those comparables, you have an estimate of what the value is on that property. That's very nice.
Yeah, just so the way we work, it's not only comparables, we use the income and expense approach. So I have a team here headed by a young guy who's fantastic, and he can look at any property anywhere in the country, no matter what kind of property, a strip center, a single family home, a mixed use, wholesale, it doesn't matter. And he can come up with a value using the data out there. So it's complex. Because we're looking at rents, we're looking at expenses, we're looking at vacancies, we're looking at all kinds of things to come up with it. But yeah, we come up with our own values.
Right. So I'm gonna give you a tough question because I know that every scenario is different, and I know that people, when you're gonna do a loan, you have to examine all of different options because you do have multiple products to help people to buy a business or to buy a real estate property. But let's assume that someone is trying to buy an investment property, and what would be the best? What typically is the best source? Is it if I'm gonna put myself, for example. I have a good credit score. I have very limited cash, and I have my own property where I have equity, the property that I live in. I also have a property that I'm renting, an investment property. And what is typically the best option where I'm going to get the best terms? Is it to get a HELOC out of my property that I live in, to get a second mortgage, or to get a blanket loan out of my property that I have as an investment? Which path is typically the better option to get along with you?
You know, better is a subjective word. You know, what my wife thinks is better and what I think is better are two different things. You know, but I'll answer your question. You know, a HELOC from a bank is probably the cheapest way to go. But you have to realize you're risking your house. You know, people are very easy to take out debt and to sign debt, and they think everything's going to be great. They're not mentally prepared to deal with if things don't go well, what's going to happen. So it's going to be usually cheaper to take a HELOC on your home, but you have to realize And your wife and your kids have to realize that you may lose your home. You're risking your home. So I would tell you, look in your, I don't know if you're married, and not you, I don't know if, I would say look in your spouse or partner's eyes, and do you want to have to tell them, hey, we lost the home? Look in your kids' eyes, and do you want to have to tell them that? So, I would say that you would have to measure that. But going for a HELOC is definitely going to be the cheapest. It may not be the best. I would argue it's not the best. I would argue that you don't want to put your home at risk for money you may make, but you may lose money. People don't go on these podcasts and on the radio and TV and say, hey, we lost money in real estate, but it happens all the time. Every day of the week, people are losing money, but people don't like to talk about it because it's not profitable, it's not sexy, it's not exciting, but it's a reality. It's a reality.
I love what you just said because you've been very transparent about the facts. And the facts are that most people don't make money. And only a few ones, like you said, a few ones that throughout 10, 15 years, they've been doing it successful. Because you do not hear the bad stories. You only hear the good stories. And that's why I appreciate the fact that you're giving a straight answer. Now, obviously, if I have an investment property, and I take a blanket loan or a second mortgage or whatever the case might be, if I get to lose it, it's just an investment property. It's not my own property. And I appreciate that transparency that you're providing here. Now, when you buy a commercial property, in this case, do you guys, you guys close really fast. How do you guys ensure that that property has the minimum qualifications in regards to, for example, an inspection? I mean, an inspection can go wrong and it can have multiple severe situations like the drainage or the structure. Or how do you ensure that you're not getting into a property that is, with a severe problem?
Yeah, it's a challenge, but you look at the age, you look at the inspection report, and effectively you bake that into it. And this is why we're doing deals at give or take 65% leverage. So you have a cushion. If something goes wrong, it's protected.
So you do have to see the inspection report then.
Well, what we do is we'll either do an inspector, not an appraisal. We'll send someone there to take pictures and do an inspection. Okay. Or a lot of times what we do is we'll do a Zoom call with the individual or a FaceTime and say, walk around, and we record it. And we'll look at the heater, and we have someone in the office who can tell what's going on with the property by that.
That's very unique. That's the way to do it. I love the entrepreneurship that you guys have there. Well, that's awesome.
Yeah, look, we need to compete. There's a lot of people who want to do business with investors. So we need to be different. And how can we be different? By offering better service, by being more flexible, by being fast, by calling people back on a Sunday or a Saturday night or, New Year's Day or Thanksgiving Day. So we're working very hard to make our borrowers want to do business with us.
You said that you don't require or you don't really pay attention that much to the credit.
Correct.
And credit FICO score is not, you don't make a decision based on credit. However, what about if someone doesn't have documents or credit report, doesn't have no credit, and maybe is someone that immigrated and doesn't have anything, not even a Social Security yet? Can they participate with you without a Social Security?
We're looking at the property. We're putting 95% of the decision based on the real estate. So if you find or you have good real estate, we want to be there. If it's not good real estate, we don't want to do the deal.
So if it's a tourist from Brazil or from Spain coming in and they want to use you, you're not going to ask for the Social Security.
That's correct. Yeah, we have plenty of those on the books, plenty of them.
All right. Very good. Another good option for those that don't have a Social Security and they're planning to invest in this country. Now, second mortgages is something that I see that you also offer. When is it a good option normally for a second mortgage?
We're a little cautious with seconds in this market, but we're doing what we call mezzanine on multi-tenanted commercial property. So if you have an apartment building, let's say, and the rate is very low, but you have a lot of equity, we would consider doing a mezzanine loan, a second mortgage on that. and you don't want to refinance it or sell it because the rate's low. So that's something we would do.
Okay. Um, in your in the industry that you are, I know that you're a private lender and you don't follow guidelines of conventional loans or QM, what we call QM loans. You don't follow those guidelines. However, there are there is some oversight from different entities. I would assume the CFPB is one of those that. And I'm not going to talk about politics, but I do want to ask you a question about the future of in this country in regards to compliance, in regards to oversight, government oversight. Do you see major changes to make things a little bit more relaxed in the housing industry, real estate industry in the coming years?
It's a tough question because, first of all, you can't ask me about politics. It's fascinating to
I'm
talk
not.
about. It appears, based on what you hear out of this administration, regulations may be more relaxed. But I can tell you, over the past 20, 25 years, they've been slowly gotten tighter and tighter. So, I believe over the long term, they will get tighter and tighter. They'll continue to tighten up at the federal, at the state, and at the local level. There may be a reprieve from it because of the current administration, but we'll have to see. We'll have to see.
Great, thank you. Rates. Is the most common conversation among our industry, housing industry, and real estate. In your magic ball that you have next to you, where do you foresee the rates being in the next 12 months? Higher, lower, the same? What do you see in the market?
Yeah, I really don't know. It's just a guess. I started in these when rates were, I remember doing a loan at 15.75%. And prime was that under the Jimmy Carter era. So I've seen high rates, I've seen low rates, and people always ask the same question: what are rates going to do? I said they're going to go up and they're going to go down. I can't put a time frame on it. Anyone is just guessing. My gut is they're probably going to stay about the same because you have inflation that's going to be out there. But you have the national debt too. So I'm guessing it's going to be about the same, but I have no clue. I wish I knew.
I appreciate your opinion, because at the end, no one knows, but we are looking to make another video in regards to everyone's opinion on what is the future of the rates. So we'll include yours because at the end it's an opinion.
Yeah, I can tell you they're going to go up and they're going to go down. I can't put a time frame on it.
Sounds good. Well, we're almost about to be done. I just want to ask you one last question. I mean, someone with your experience, what would you say to someone that is starting on this financial industry, either to do as a loan officer or as a working for a finance company? You have 40 years of experience plus, but what would you tell a young Jack that he's on his 20s? And with all of this experience that you have now, what would you say to him if you have it in front of you, to a young Jack Miller?
Invest in yourself. Learn, 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 and be prepared to stick it through the challenging times. And it's the best career. It's the best career a person can have. And I'm the luckiest person in the world to be able to stumble upon it. Again, it's hard work, but it's a fantastic career.
You said something that you caught my attention. Is so true. Most people talk about the good things and they talk about their success, but people don't like to talk about failure, and that's how we learn. Can you share with us one of your biggest failures that we can all learn from it, that you always remember?
I've had the truth. Yes, I can, but I've had so many that it's hard to pick one. But
Just one.
pick one.
Just one. One.
It had to do with signing personally and taking on too much leverage, and as a result, a lot of pain in the 2008 to 2011 financial crisis around real estate. But if you stick it out, whatever happens in real estate, if you wait through the cycle and survive the cycle, you'll go through. You know what? I'm going to revise if I had to have one mistake, I'm going to revise it if that's okay. It's selling a property. Selling a property. Every property I've ever sold, I'm sorry I sold.
You know what? That's I like that. I think I have the same problem. Every property I sold, 5-10 years later, I say, why did I sell that property?
That's exactly right. Well, it's generally because you need money at the time or there's a problem with the property. but selling is really the biggest mistake.
That's so true, Jack. I appreciate that. That's very, very valuable. I hope that everyone that is seeing, they learn from that, especially young people. This is something that we're trying to. Uh, the other day we were talking about why is it that young people that are in their 20s don't listen? Don't listen to experience. I didn't listen, obviously. I mean, it happened to me. I don't know about you, Jack, but most people that are young don't listen to experience, and we're trying to change that. We're trying to make sure people can listen to the, to the experience and to the mistakes that other people made when they were young. Jack, thank you so much. Anything else that you want to add?
No, I just want to encourage everyone. It's a fantastic field, a lot of obstacles, but it's a great field and a great way to make a living and have a lot of fun and have a lot of freedom as well. And I want to thank you because you're doing your listeners and your viewers a tremendous service by educating them. So really, you deserve the credit, and it's an absolute pleasure to be with you today.
Thank you, Jack. And this was the People Matter show. Hope that you enjoyed it. I will see you next time.